What if I told you one of the most talked about ETFs for 2025 isn't flashy or flashy stocks? It barely touches tech at all, yet is quietly outperforming expectations while building wealth through dividends? Introduce SCHD, an ETF with an impressive following and proven past performance that's rapidly amassing fanatical fans. But should investors trust its promises for 2025? Or are investors being misled by past performance? In this video, we take an in-depth look, not just into numbers, but also strategy, sectors, and any hidden strengths or risks. If you're trying to decide whether SCHD belongs in your long-term investing plan, or whether something else may be more suitable, stick around. You'll come out of this video with an answer that stands up. Disclaimer: the content provided on Bearish to Bullish is for educational and informational purposes only. Nothing in this video or on this channel constitutes personalized financial, investment, or tax advice. All investing involves risk, including the possible loss of principal. Past performance is not indicative of future results. Before making any financial decisions, you should consult with a qualified financial advisor, accountant, or other professional to discuss your individual circumstances. What exactly is SCHD? It stands for Schwab U.S. Dividend Equity ETF, launched by one of the nation's premier brokerage firms, Charles Schwab, in 2011. SCHD is designed to track the performance of U.S. stocks with high dividend yielding capabilities that have an established track record of consistently paying dividends and are in good financial health. Its underlying index is the Dow Jones U.S. Dividend 100 Index. This measures roughly 100 top dividend-paying U.S. companies selected based on quality and sustainability of dividend payments. In essence, SCHD provides investors with an avenue for steady dividend income combined with long-term capital appreciation potential. Before we dive deeper into SCHD's numbers, let's first take a step back and understand why dividend investing has become such a hit, and why dividend ETFs like SCHD have seen such dramatic popularity surges. Dividend investing is nothing new. Companies have long used dividends as a method of returning profits to shareholders through dividend payments, providing regular income streams to retirees and anyone seeking less volatility in their portfolios. ETFs have made dividend investing much simpler over time. Instead of purchasing individual stocks, an ETF offers instant diversification via ownership in many dividend-paying companies. In 2011, following the 2008 financial crisis, investors were in need of income but cautious of risk. SCHD quickly gained popularity because it combined dividends with quality filters that selected financially sound companies. Now let's talk numbers. How has SCHD performed since its establishment in 2011 and through 2022? Since inception through 2022, SCHD generated an approximate return of 182%, with both dividend reinvestment and capital appreciation making an appearance. Not bad at all. Put that figure into perspective. The S&P 500 saw an overall return of approximately 173% over this time frame, suggesting SCHD slightly outshone its peers. But here's the trick. When looking year by year, SCHD typically outperforms in sideways or down markets due to dividends helping cushion losses. For instance, during market downturns such as those experienced during 2015 to 2016 and 2018, SCHD fared significantly better than its rival S&P 500 index funds. However, in the recent tech-led bull market since 2020, SCHD has lagged behind. While tech-heavy S&P 500 and NASDAQ indexes have seen dramatic gains, its limited tech exposure limited SCHD returns closer to 25%. Thus, its main strength lies in providing security and income while not acting as an explosive growth ETF. Why does SCHD perform this way? The answer lies in its sector allocation strategy. Here is an outline of its top sectors today. Consumer staples account for approximately 19.4% of portfolio asset values. Energy comprises 19.1%. Healthcare 14.2%. Industrials 13.1%. Financials 8.8%. Notice anything different? These sectors tend to be more cyclical and income-oriented rather than tech-driven growth sectors like those driving recent market rallies. Technology only accounts for 8.7% of SCHD, while communication services, another growth sector, account for just over 4.9%. Compare that to the S&P 500, where tech represents 28 to 30%, or NASDAQ, where tech makes up over half the index, and you'll quickly understand why SCHD trails in these booming tech markets. But traditional sectors offer resilience as well. Financials tend to benefit from rising interest rates. Healthcare is an ever-present sector. Consumer defensive companies sell essential products regardless of economic cycles. Energy often rises with inflation, and industrials often see infrastructure spending increases. One of SCHD's chief advantages lies in its dividend profile. Right now, its yield stands at roughly 4.02%, well above that of the S&P 500 average, which currently sits around 1.5%, making SCHD an appealing option for investors seeking reliable income sources. Yield alone doesn't tell the full story. Dividend growth should also be taken into consideration. SCHD boasts an impressive 5-year dividend growth rate of roughly 11.99% annually. This means your dividend payments have been increasing at double-digit rates annually over that period, providing long-term income growth potential. SCHD has achieved 12 years of consecutive dividend increases across its holdings, attesting to their quality and financial strength. SCHD's strength lies in its combination of solid dividend yield and growth, something neither DGRW or HDV can match fully. As we look ahead to 2025, why might SCHD be advantageous? Politics and economics play a significant role in market performance, especially under President Trump 2.0. His forceful deregulation efforts are projected to benefit the financial sector, which makes up 8.8% of SCHD. This could lead to increased profitability and enhanced returns for banks and insurers. Meanwhile, energy companies, which represent 19.1% of SCHD, may also benefit from policies favoring fossil fuels and reduced environmental regulations. Furthermore, experts anticipate a boost to energy stocks with inflationary pressure and rising commodity prices projected under current global conditions. Healthcare's weight of around 14.2% is also noteworthy, given its resilience against recession thanks to demographic trends such as an aging population, chronic illnesses, and ongoing innovation. Industrials, 13.1% of total exposure, could stand to benefit from infrastructure spending and economic rebuilding plans that are prominent issues in Washington. Our sector mix matches up well with those who could gain from economic stimulus measures or policy support in 2025, creating potential catalysts for growth. Any investment risk is inherent, and SCHD presents its own set of challenges. Sector concentration may become an issue should technology stocks outperform broad market indexes. Interest rate changes also influence SCHD, with higher borrowing costs potentially decreasing earnings, and dividends for financials and energy firms. Rising rates can boost bank profitability via wider net interest margins. Market volatility and economic recessions can pose risks to dividend stability. However, SCHD's focus on high-quality companies helps mitigate that risk to some degree. Geopolitical events, inflation rates, and regulatory changes all play a part. Therefore, diversified sectors should be prioritized when investing in them. Who is SCHD appropriate for? It's suitable for investors seeking exposure to high-quality U.S. companies, but are not comfortable with tech ETFs. SCHD can serve as an invaluable diversifier if your portfolio relies heavily on growth stocks or international equities, reducing volatility with their focus on financially sound dividend payers. Retirement or income investors will find comfort in dividends and dividend growth, which can help offset inflation. For maximum growth potential, tech-focused ETFs such as DGRW might be ideal. For pure income generation, HDV could also be considered. To conclude, SCHD is more than just an ETF. It offers a carefully curated portfolio of dividend-paying companies across multiple resilient sectors that promise higher income returns over time. With its 4.02% yield and 11.99% dividend growth rate, paired with economic and political tailwinds, SCHD should be among your top considerations for dividend ETF investments in 2025. Every investor's situation differs, so before taking the plunge, it's important to carefully consider your goals, risk tolerance, and existing portfolio before diving in. Now, I want to hear from you. Are you optimistic about SCHD for 2025, or do you anticipate other ETFs or strategies will outperform it? Do you believe technology will continue to be the market's hottest sector, or are dividend ETFs like SCHD poised for greater performance? Comment below and join the dialogue. If this video was helpful to you, be sure to hit like, subscribe, and ring that bell so that you won't miss our next market breakdown. Thank you for watching Bearish to Bullish. Please remember, investing isn't about picking hot stocks. Rather, it involves understanding the market, managing risk effectively, and creating a portfolio tailored specifically to you. And until next time, are you bearish or bullish on SCHD?